In this video today, we will go through how to compare investment alternatives, and we'll use several different ways of looking at this. We'll use accounting rate of return, payback period, net present value, and the profitability index. So here are our projects that we can choose from with all of their initial investments, the additional cash flow that they will create each year, their useful life in years, and the salvage value of each one. The first thing that we would like to do is determine each project's accounting rate of return. For project 1, that is 10.1%. For project 2, it's 25%. And for project 3, it's 24%. So how do we do this? On project 1, for example, we take the additional cash flow that is generated each year. We subtract from that a value, which is the $6 million initial investment, minus the salvage value of $1.25 million divided by 8 years. That gives us $606,250. That number is then divided by the initial investment of $6 million to get the 10.1% rate of return. For project 2, it's the $1 million additional cash flow divided by the $4 million initial investment, and that gives you the 25%. For project 3, we take the 1.2 million additional cash flow per year divided by 5 million initial investment, that gives us 24%. Second, we want to determine each project's payback period. For project number 1, to do that, we take the $6 million initial investment and divide by the 1.2 million additional cash flow per year. That gives us a payback of 5 years. For project 2, we have 2.22 years. For project 3, we have 2.98 years. And what I've done here for each of the payback periods is put in brackets how you would actually calculate those numbers. And if you have any questions about those, please feel free to leave your comments or questions below. Next, we use a discount rate of 10%. We're going to calculate the net present value for each project. So for project 1, we have an initial outlay of $6 million, and we use a table factor of 1 because that's the amount of money that we're actually upfront putting as an investment into this project. For years 1 through 8, we use the present value of an annuity table, and we look up the table factor for 10%, 8 years, and that factor is 5.3349. We multiply that by the additional cash flow each year of 1.2 million, and that gives us $6,401,880. Then in year 8, we have the salvage value of 1.25 million. We multiply that times the table factor from the present value table, and we look at 8 years, 10%, and we get a factor of 0.4665. That multiplied by the 1.25 million gives us 583,125. The net present value for that one project then is netted, all of those numbers are netted together, gives us a net present value of $985,005 for project 1. For project 2, the initial cash outlay is $4 million. For years 1 through 5, we have 1.8 million that is being generated. Now, I have shown over on the right-hand side what we're actually adding to the $1 million. So part of this is depreciation that we need to add back into it. So you can see over there on the right-hand side how we're adding that back in. So for the cash flow there, we have 1.8 million times a table factor of 3.7908. Now that 3.7908 is using 5 years, 10% from the present value annuity table. So our net present value for project 2 is $2,823,440. And then finally, project number 3, we have an initial outflow of $5 million. For years 1 through 10, we have $1,680,000 that is being generated. And again, that's adding back in the depreciation amount each year. The table factor that we're using from the present value annuity table is 6.1446, and that's using 10%, 10 years. Then in year 10, we have a salvage value, and that we're using the present value table to get the table factor of 0.3855. Overall, the net present value for Project 3 is $5,400,028. And finally, we're determining the profitability index for each project, and then we're going to prioritize them based on that. So for project number 1, we have a profitability index of 1.1642. And I've put there in brackets how I'm actually arriving at that number. So you can see it's pulling information from where we calculated net present value. So we're taking the net present value of the inflows and dividing by the outflow to give us 1.1642. For project 2, it's 1.7059, and for project 3, it's 2.08. To rank the projects, we would want to go with project number 3. It has the higher profitability index, then project 2, and then project 1. That's how we would rank them. If you have any questions about these, please do leave your questions or comments below. I'll be happy to get back to you if you have a question, and I look forward to seeing you on another video.